Reserve Bank of India is due to table their midterm policy in less than 2 hours. What are the expectations? Thoughts on that from Gaurav Kapoor, senior economist with RBS. Gaurav, never say never in this market, and after last week's surprise cut in CRR, do you think Reserve Bank of India today could surprise everyone with a repo cut?
Well, I seriously doubt that. And I think, let me say that the CRR cut, only to the extent of timing and perhaps the extent was a bit of surprise, but otherwise the CRR cut was largely expected today. The reason I don't think there will be a repo cut today is, I think, as one inflation data came out yesterday, pointed out that the momentum of inflation is still fairly strong. And even despite that, I think there are suppressed inflationary pressures in terms of global crude oil prices have not been passed on, or there's an incomplete pass-through. You have seen 20% increase in railway freight rates rather. And in April, you're likely to see across the board increase in electricity rates across the country. Food prices seem to be hardening again from what the WPI data points out. So I think there are still a number of inflation risks or inflationary pressures which the RBI would have to take into account. It's already laid the groundwork for, and in some sense, it's already, monetary easing has already started with about 80,000 crores now being pumped into the economy through the CRR cut, which is basically to some extent neutralizes the intervention the RBI has done in the forex market. That said, I think, and from a growth perspective, the RBI would take into account the fact that third quarter of the previous fiscal, basically the October-December quarter, was perhaps the quarter where things seem to have bottomed out. And even there, I think there is a possibility that the GDP number will be revised upwards from 6.1% perhaps on to about 6.4, 6.5, depending on what is the final estimate for the farm sector. In the first quarter of this calendar, or the last quarter of this fiscal, at least in the first 2 months, the PMI data points out that there has been an appreciable improvement in activity, both in manufacturing and services. And I think RBI would kind of try and balance this out. And let's not, I think, and more importantly, they would want to see what the government and how the government goes about in the budget tomorrow, what kind of fiscal consolidation is being talked about, whether, unlike last year, whether this year the subsidies are adequately provided for, and whether the budget again tends to push consumption than investments. So I think those considerations are also important for the RBI before they embark on cutting rates. They've already indicated the rates have peaked. They've already kind of cut CRR by 125 basis points, and I think they can at this point in time take a pause and see how the things go, because I mean, if this is the end of the year review, I mean, it's actually the last review for the year, and as we get into April, they would have to take a better sense of the growth environment and inflation for the next fiscal. So we still feel that this policy might not see a rate cut, and I think things will only happen as we get into the next financial year.
So Gaurav, what is it that you're expecting by way of an inflation figure for FY13, and where do you see it for FY12 close as well, and how pronounced do you think are going to be the key risks of rupee depreciation as well as oil price rise impacting inflation during FY13?
I think for FY12, first of all, we have only 1 month or number to go. I think that number is likely to remain below 7 until and unless there is March is almost half March is over, and we've not seen a fuel price hike. So I think what it does is that as we get into the first half of the next fiscal, there will be a huge kind of overhang of this incomplete pass-through we've seen, especially in case of diesel prices and LPG prices. So as we get into the next fiscal, I think first half of the year also has a fairly significant high base effect, which means that inflation can still by and large remain on between 6 to 7% range. And as we get into the next fiscal, I think we'll also have to take into account how food prices behave, because as been articulated by the RBI itself, in terms of food price inflation, we've kind of moved up structurally. Other than that, I think global crude oil prices are holding up, and in the last fiscal, the average has been around, or rather this fiscal, the average has been around 110 plus for the Indian basket, and prices since then have moved up. So there is a significant amount of pass-through which needs to happen if the government doesn't want to balloon or bloat its subsidy bill any further. So I think that will mean that over the next 6 to 9 months, you can see about 50 to 75 basis points coming in on account of higher oil prices and a weaker rupee actually accentuating that. Because I think even on a relative basis, though even the rupee has stabilized, I think we are starting the next fiscal, and for a better part of the next fiscal, rupee will perhaps hold on in the range of about 48 to about 51, which means it's on a relatively weaker side compared to what it was in the same period last year. So in a sense, inflationary pressures are building up. Some of them have been suppressed, and I think those will begin to show up. And along with that, if food price inflation also starts to pick up, and food price inflation, a lot of it is actually coming in from non-food grain, non-cereal kind of inflation, which is where the supply response has been inadequate. So I think risks to inflation are still on the upside, though I think given the fact that we are coming from a higher inflationary year, the base rate will dampen the headline number.
All right, Gaurav, appreciate your time. Thank you for your insights. So the view from the House of RBS is that we should not expect any repo rate action today from Reserve Bank of India.